Financial technology has changed the way we think about money. In the past decade, it pushed for new ways to pay, bank, and invest. And now the focus is on using artificial intelligence and tokenization to innovate. As the Singapore Fintech Festival celebrates its 10th year, my colleague Sarah Al-Khaldi sat down with Ravi Menon, chairman of the Global Finance and Technology Network, to talk about how Singapore's fintech sector could evolve in the next decade.
I think going for the next 10 years, we will see an expansion of multilateral digital payment systems, more connectivity, faster settlement times. Asset tokenization still hasn't run its course. In fact, with the crypto winter, I think we've seen a branching point. We've become more cognizant now of some of the downsides and risks in that space, while the benefits continue to be compelling. And so the key challenge for the next 10 years is to figure out the good from the bad, the benefits and how to harness the benefits and how to manage the risks. Principally, I think the private cryptocurrency space continues to pose risks. Risks in terms of consumer protection, governance, and so on. I think the stablecoin space and the CBDC space offers good prospect for digital money. And work continues on the underlying settlement platforms. If you get it right, we could have a much more efficient, robust, and resilient financial system. But it's still some ways from there. So I think there's a lot of work in the next 10 years to get that infrastructure and governance right.
So stablecoins are definitely gaining traction globally. How do you see them fitting in the broader fintech space, especially with a CBDC, central bank digital currencies? Would they kind of overlap or be complementary?
I think there is space for both of them. I think they can be complementary. In fact, I'd say there are three models of digital money or tokenized money that you can use on digital platforms. One is CBDCs, which is central bank issued currency that's tokenized and placed on distributed ledgers. Today, you already have two kinds of money: notes and coins, which are issued by the central bank, and all of us hold bank deposits, which are really liabilities of the bank, not the central bank. It's bank-issued money, but backed by reserves. So similarly, I think in the tokenized world, we will see the equivalent of notes and coins are CBDCs, digital money. And then you will also see bank liabilities, where bank deposits are tokenized. So if you tokenize part of your bank deposits, you can use that in tokenized form for transactions at theoretically zero settlement cost. And then the third contender is stablecoins, which are essentially the same thing: digital money, tokenized, but not issued by banks, but issued by non-banks. And so they need to be very well regulated and fully reserved, which is what I think leading jurisdictions do in their regulatory structures. And Singapore introduced stablecoin regulations. That was one of the key points, that the stablecoin issuer has full backing in cash for the tokens that are being released, so that if you hold a stablecoin regulated in Singapore, issued by a Singapore-based entity, you can have assurance that the stablecoin you hold is fully backed by cash elsewhere. So I think if it's well done, all three have a place in the new monetary system. All three will serve their purpose, and people will have choice across holding any of these three.
With, of course, the evolution of fintech has come a new wave of risks, right? There's payment fraud, there's investment scams, and phishing. So has the industry, you think, maximized the available tools to ensure that innovation is done in a way that is safe and secure for everybody?
I think there's been lots of improvement in the last few years, and I think you would notice when you make payments now for certain large sums, or when you have a new recipient, you have to jump through an additional few hoops, which are the kinds of protections we are putting in place, whereas continuing to make it very easy to send small amounts of money to trusted recipients whom you always send to. So we need to get that balance, because if we overdo the controls, we'll be back to the old days where payments is such a pain. We want it to be convenient and easy for as many people, for as many transactions as possible. but making sure that the higher risk transactions are well protected so that scam risk is well managed. I wouldn't say the job is done. I think we still see scams, which is very sad. So I think this will take a couple of years more before we have a much fuller set of measures and controls, and with enforcement improving, if we can break some of these scam rings, that will go a long way. But that's always been the way technology has evolved. I think when the internal combustion engine first came on board, many road accidents, many fatalities, seat belts were introduced, traffic signs were introduced, traffic rules were introduced, driving skills were improved, a whole lot of set of measures were put in place, and today it's fairly safe, not completely, but it's mostly safe.
And my colleague Elizabeth Nyo will bring us live coverage from the Singapore Fintech Festival, which begins on Wednesday, and she will be speaking to industry players and experts.